Good morning, everybody. Thank you so much for joining the BER for this webinar. My name is Lisette IJsselder-Schepper, and I'm a senior economist at the BER. I would like to welcome the BER's clients, our sponsors, as well as some staff and students from the economics department at Stellenbosch University that are online. I would, however, like to extend a very special welcome to the survey participants that are part of today's session. Without you, there would be nothing to discuss today. We're going to talk through the BER business survey results covering the services sector. We'll kick off with George Gershoff, our Deputy Director. Then we'll move over to Elanya Fourie, a Senior Economist at the BER, who will talk about the retail trade survey. We're also honored to have Mamelo Matikinganyena online and Lynette Ellis. Mamelo is from FNB, and FNB has been a long-term sponsor of the FNB BER Consumer Confidence Index, while Lynette is a consulting economist to the BER and a consumer specialist. If you have any questions or comments, please use the chat box or send us an email to berconference@sun.az.za. In the interest of time, we're not going to allow the hands up and down function, but you're welcome to use the chat during the presentations, and there will be a dedicated Q&A session towards the end. With the housekeeping out of the way, I would like to hand over to George, who's going to start with the presentations.
Thank you, Lisette, for that introduction. Yes, those of you that logged in a bit earlier would have seen that's what is services in South Africa. It covers, the economy covers three different sectors: the primary sector, the secondary sector, and the tertiary sector. And in that, we see that the services sector makes up a full 2/3 of GDP and almost 3/4 of employment. So it is quite an important sector. Today we cover, within the services sector, there are 5 subsectors: the trade, catering and accommodation, followed by transport, storage and communication. Then we have quite important and big contributor: finance, real estate and business services, followed by government services and personal services. We will cover elements of these. Elanya will look at wholesale, retail, specifically retail, and then the motor trade, so that sector. And then I will be covering catering and accommodation, or better known, restaurants and hotels, then transport, real estate and business services. So you would see all these sectors contribute quite a substantial part to the GDP. But even if you look at retail, for example, 7% of GDP, but a full 11% of employment. Even the smaller hotels and restaurants, 1% of GDP, but a full 3% of employment. If we think about, the tourist industry, then it falls in different subsectors. So we have the hotels and certainly restaurants, but also a bit of retail. And then within transport, passenger transport specifically is also a part of the tourist sector. This is when we look at the economy from the production side. There is also a way of looking at it from the expenditure side. Then we have consumer spending, government spending, fixed investment, and then we provide for exports and imports. But within consumer spending, important today is also the spending of consumers on services. Just two more slides. We already mentioned industry, which covers the building and manufacturing sector. And after it fell to a record low in the second quarter of 2020, when the lockdown started after the outbreak of the pandemic, it bounced back fully. Initially, it was mainly manufacturing, and then later on with about a 4 quarters lag, it followed with the building sector. So manufacturing reached a new peak after the lockdown in about the second quarter of last year, whereas building only did so in the second quarter of this year. But since then, both manufacturing and specifically building trended lower. If we then add services, which we are covering today, then we see that has now surpassed the other two sectors, but also the long-term average. And it is at quite high levels relative to what we saw in 2015, even at the end of 2018, when there was great excitement when President Ramaphosa take over the leadership of the country. But although it bounced back significantly, it's still not as strong as it was after the global financial crisis in 2011, and it is way below where it was at the previous huge upswing in 2006 and 2007. In my last slide, before I hand to Hilanya, we see we break up this services in its two components. Here we have the domestic trade, and Hilanya will be speaking about retail specifically, but this covers the average of retail, wholesale, and the motor trade. And we see here it also peaked in the first quarter of last year, and since then it has trended downwards. The downward trend was more evident in motor trade, and there they struggled a lot with unavailability of stocks. It is not so widespread in the case of retail, but then the other services that I cover later on, the hospitality, transport, real estate, and business services has now surpassed the internal trade. So it is very much a case of Johnny arrived lately, or as we say in Afrikaans, agter ons kom ook in die kraal. And this is more not only the lagged effect, but specifically because this sector was affected for the longest period of time by the restrictions to prevent the spread of COVID-19. So if you think back to the fourth quarter of last year, when the Omicron variant emerged and renewed restrictions were implemented in South Africa and a travel ban. So only since about June, July this year, there are no restrictions. And so this sector is finally able to recover fully, whereas the other sectors did so earlier on, and therefore it is no surprise that only now we see confidence in this other services reaching a peak. But to delve into the detail, I'll now hand to Hilanya.
Thank you, George. I'm just waiting for my slides to load. I hope everyone can hear and see me. There we go. All right, so I will speak specifically about our survey of the retail sector, but I'll also include a brief methodological overview of how we estimate our indices, as these are largely consistent, or rather as the method is largely consistent across all of our business surveys. If there's one message that I hope our audience can take from today, it is that our survey results really provide a very good and a very useful view of the economy, but it's important to read them within the broader context. It doesn't make sense just to look at one number and one observation at a specific point in time. You also need to consider what happened in the past and how that specific number or index value compares to what else is happening. But first, let's dig into the retail sector. So the sector can be split into three categories. Non-durable goods make up the bulk. It includes sales by general dealers, players like ShopRite, Woolworths, Massmart, etc. But it also includes retailers of specialized food and beverages, tobacco, pharmaceuticals, cosmetics, and toiletries. Semi-durable goods include things like textiles, clothes, footwear, and leather goods. And durable goods is then your household furniture, appliances, and equipment, but also things like hardware, paint, and glass. So that's just a quick recap of what this sector is made up of. What is interesting about the retail sector is that it follows very clear seasonal trends throughout the year. There's often a large spike in the fourth quarter, brought about by sales of Black Friday, as well as Christmas and the festive season. Then there's a steep dip in January as everyone's bonus money has been spent, but then sales again increase towards March and take a dip during the winter months. Because of these seasonal trends, it's important to specifically think about year-on-year growth rates when looking at the sector and to interpret month-on-month changes with care. A big drop between December and January might look frightening, but actually it's fairly standard. There are two other points that I would like to highlight here because it affects the interpretation of our indices. The first is the low level of sales that we saw in July last year. This was brought about by the looting that we saw in KZN and in Gauteng, but there were also still some restrictions on movements in place and an alcohol ban that limited the sales of alcohol. So when we think about sales in this year's July, we are comparing to a low base. We'll speak about that again in a second. The other point I want to highlight that we can clearly see from this data, the Stats SA data, is the big dip in sales that we saw right at the start of the COVID pandemic in April 2020. So we can unpack that a little bit more. The pandemic had varying effects across the different retail subcategories. Non-durable goods proved to be the most resilient. People, of course, need to continue buying food and groceries when a crisis hits. And we would all rather then limit spending on discretionary goods like clothes or new clothes, at least, and household furniture. As a result, also as one would expect, semi-durable goods took the biggest hit. We stopped buying the type of things that we need to appear in public, for instance, or to dress up for work. So of the three categories, spending on semi-durable goods also took the longest time to recover, exactly because there were still restrictions on movement in place. Durables also took a dip, but it bounced back quite rapidly. We all started getting fed up with looking at the cracks in our walls and our uncomfortable chairs at home, so we started investing in our home spaces. But as that trend has also now sort of become weaker, I guess, or as we've started spending more on semi-durables rather than durables, we can see here that in the recent couple of quarters, spending on durable goods has slacked. We'll chat about that again in a second. Overall, the sector has regained its losses from the pandemic. This year's sales between January and July, at least, compared to the other years, shows that we have surpassed the level where we were in 2019. So that's, of course, encouraging. But on the other hand, we know that high inflation and rapidly rising interest rates are putting pressure on disposable income and that consumers are under pressure. So it's difficult for retailers to make decisions about things like inventory purchases or pricing based on data that is 3 months old, as we see here with the Stats SA data. We are almost in October, and the most recent Stats SA data available is for July. So that is where the BER's retail survey can come in quite handy. It gives us a leading view of what might be expected from the rest of this quarter and also to an extent from about next quarter. A little bit of background about how it works. It is primarily an online survey, which we send to a sample of retailers across South Africa. It's sent to the same retailers each quarter, so the respondents effectively become a panel, which is, of course, quite nice to work with. Each respondent's answers are weighed according to the firm's size as well as to the sector's contribution. We ask qualitative questions that are short and simple to answer. The respondents among our audience will be very familiar with this interface. And then we use this information to estimate our indices. For instance, for something like business confidence, we ask respondents whether or not they are satisfied with the prevailing business conditions. And then the index is as simple as knowing what share of respondents answered that they are in fact satisfied with current conditions. That then becomes our business confidence index. For some of our other questions, things like questions around sales volumes, orders placed, that tells us something about inventories, the number of people employed and the rate of price increases. We ask respondents to compare their experiences this quarter with the same quarter last year. So that is an important point to make. We're not comparing with the previous quarter, specifically to address these seasonal trends. So for instance, our 2022 Q3 results are relative to the 2021 Q3 results. And we then ask our respondents to say whether something like sales volume is up, down, or the same as the same quarter last year. We also ask about their expectations for the next quarter. And for instance, if we know that the next quarter is the fourth quarter, which is the case currently, then we also interpret this data with care. So if many respondents say that they expect sales will be up, we know that, okay, it is because usually sales does go up in the fourth quarter because it's typically a strong quarter. So to then estimate the indices for things like sales volume, employment prices, etc., we look at the share of respondents that answered expectations or that answered up, and we subtract the share of respondents that answered down, and the net difference then becomes our index value. To put it even more simply or simpler, if an index value has a positive, if an index has a positive reading, it means that more respondents answered up than down. And of course, if it has a negative reading, it means that more respondents answered down than up. So with enough data points, this effectively becomes comparable to a year-on-year growth rate because we're comparing to the same quarter last year. That being said, it's difficult to interpret an index value in isolation. If I told you that confidence in the retail sector was 51%, as it is this quarter, it's hard to know whether that's high or low or better or worse than usual. For that reason, it's useful to compare to the long-term trend. And in this case, business confidence in the retail sector, it's great. We have data going back at least to 1974. So you can really see how the economy has tracked and how the sector has done. We specifically also compare to a long-term average, which at the moment we estimate as relative to the period after the financial crisis, 2009 to date. So we can also see that the current reading of 51 is quite far above the long-term average. Some other interesting observations from looking at this trend, we can see that the impact of the COVID pandemic was really unprecedented. The sector took a very big dip. In fact, the last time confidence dived that deep was right at the start of the 1990s. We can still, however, see that confidence at the moment is below where it was prior to the great financial crisis. So this period was characterized by a commodity boom and fast economic growth. So confidence, the retail confidence reflected those conditions. And then the financial crisis struck. We had sort of average growth and then a period of economic, maybe I can even call it economic demise, which also showed up in a lower retail confidence. Since the pandemic, confidence has recovered quite nicely. But as I mentioned right at the start, we also need to look at the broader picture because we know that we know that consumers are under pressure, and specifically from our FNB-BR Consumer Confidence Index, we can see that it's sitting at the second lowest level, bar the second quarter of 2020 when COVID initially struck. So this high level of retail confidence is a little bit in contradiction to the very low levels of consumer confidence that we are seeing. To understand this better, we can look at some of the other questions in our survey. Specifically, I'll be speaking about what we see in relation to volumes and to prices. But first, let's unpack retail confidence within the different subcategories. So we can see that it's primarily driven by confidence among durable goods, or retailers of durable goods, which increased from 39% to 56% in the last quarter. But now again, we need to note that this is off a low base, because with the Stats SA data that I showed right at the start, we saw that durable goods have actually been tracking lower for a while. So it suggests that this subsector might be doing a little bit better, but it's not necessarily something that we can get very excited about yet. The pressure on disposable income and on consumers, we can see starting to play out here in non-durable goods, where confidence actually fell from 57% to 46%, still above the long-term average, so that is encouraging, but on a downward trajectory, and it will be interesting to see where it sits in the fourth quarter. For semi-durable goods, slightly up, but nothing to write home about. So for more context, let's look at what's happening to sales volumes and to prices. Here we show our sales volume index, and I think the first point to make is that we can see relative to quarter two, sales volumes are down. It's sitting right at a reading of net 1%, or index value of 1. This suggests that it is likely prices rather than volumes that might be driving confidence in the retail sector. The index value of 1, to translate that, it means really that only a net 1% of respondents thought that sales will be higher in quarter three this year than in last year. And while this is still above the neutral level, remember that we are comparing to a low base, a low quarter three 2021. If we were comparing to a normal quarter three, it is likely that the sales volume index might have declined further. But on the other hand, we also need to think that, there might also be factors that are in fact supporting consumer spending, things that aren't necessarily reflected here. The levels are uncertain, but we see from the quarterly labour force survey that it seems that at the moment more jobs are being created than what are being lost. So there could be some employment creation, putting additional spending or putting additional income into the economy. Something else that might be driving this is consumers might still have some savings left over from the pandemic. International tourism, while not yet having recovered, as George will show in a second, is on the increase, so that's encouraging. And then, of course, the broadened base of the social relief of distress grant could also play a role, and the fact that in the fourth quarter we will see the back pay of grants that were missed during April and May, which could also provide some support for sales. If we look at sales volume trends per subcategory, we see that in each instance, the indices still remain substantially above the long-term average, so that is good, but nevertheless, pressure on disposable income can be seen, especially here in non-durable goods, and perhaps also to an extent in semis. As an aside here, just to show you that the indices confirm the trends that we saw in the Stats SA data, with durable good or sales volumes of durable goods bouncing back quite steeply right after the pandemic, and semi-durables taking a bit longer to recover. In terms of prices, the results also reveal some interesting findings about where we think inflation might be going, and they suggest that perhaps we might be reaching a peak, which would of course be a nice result to show. So we show here the purchase price index and the sales price index, which specifically ask respondents to comment on the rate of price increases in this quarter. The first thing to say is that the indices still remain far above the long-term average, so our inflationary pressures have by far not abated, but it is encouraging that in the third quarter, both of these indices have come down. I think the other interesting thing to say here is that they're both sitting at a reading of 77, which suggests that retailers won't necessarily be able to absorb further price increases. They are passing all of the purchase price increases on to consumers. I think I can add here also that retailers face many other challenges that we need to be aware of. Things like increased fuel prices, increases in wage demands, etc. And I think keeping all of that in mind, it is interesting that confidence still stays at such elevated levels. And yeah, it could be because we are coming out of a particularly challenging period, but it could also be because consumer spending might in fact be more resilient than we would otherwise have expected. To confirm the price trends, we also look at retailers' expectations about the rate of price increases in the next quarter. You'll remember that as one of the questions that I showed right at the start, and it's encouraging to see that for both purchase and selling prices, the expectations of our respondents are that the rate of increases will be lower in the next quarter than in this one. So it suggests perhaps a downtick in the inflationary trends. Then finally, just a little bit on employment, because it is a topical issue in South Africa. Employment in the sector or in retail took a dip even before the pandemic. You can see it tracking down there. It reflects slow growth in the economy. Since the pandemic, there seems to have been some recovery, which is of course encouraging, and especially in the previous quarter, in quarter two, the employment index sat quite far above the long-term average. It came down a little bit, but is still above. And I think this corresponds to the QLFS data that suggests that there might be some job creation going on. So before I hand over to George, I am first going to hand over to Lynette and to Mamelu to comment a little bit more on the retail sector and specifically the consumer side of things. Thank you very much.
Thank you, Ilanya. Morning, everyone. From my side, the BR's latest survey results have certainly been quite encouraging. Despite very high goods inflation and rising interest rates and increased spending on services such as restaurants and accommodation and entertainment, retail sales volumes have not dropped off sharply. This means that the turnover growth at the retail level is still improving, and it suggests that there must be some factors that are supporting the disposable income of consumers. The 350 Rand Social Relief of Distress grant immediately comes to mind, and this grant is currently adding between 3.5 and 4 billion rands per month to low-income budgets, and it is especially supportive of spending on non-durable goods. Anecdotal evidence suggests that a significant portion of this grant is being spent in townships, and there's certainly also an employment multiplier that is tied to this spending. On top of that, the strong recovery that we are seeing in the services sector is also adding jobs and buffering the disposable income of consumers from all of these inflationary pressures. And then finally, even though interest rates are now moving up quickly, the nominal disposable income of consumers have also increased on the back of higher wage increases and this recovery in employment. And this means that the portion of consumers' income that goes towards servicing their debt is actually only increasing very gradually, and it is still well below average levels for South Africa. So even though retail sales have started to taper off a little bit, there are still some positives, especially for the non-durable goods and the semi-durable goods retailers. Thank you. Those are my comments.
Mamelo, please go ahead.
Thanks, Helena. I think Lynette covered some of the points quite well. So I think maybe in addition to the point around non-labor income, we've also seen, I guess this may impact the middle to a more affluent households, where we've seen, your non-labor income being driven by a very strong asset prices. We've seen recovery in the rental market. And the high interest rate and insurance payout have certainly helped that segment of the market. In agreement with Lynette around, the impact of the expansion of the social relief of distress grant. I think that did provide some impetus of support to consumer confidence over the past quarter, especially for that low end of the segment. Hiring intentions, I think also, as have been spoken about in the conversation this morning, those remain relatively constructive across many sectors, of course, barring the construction sector. And it does indicate that there is potential for, I guess, modest job gains in the short to medium term. I think, again, to Lynette's point, and your point, I think you made the point quite well, Helena, is that even though we're seeing some recovery in consumer sentiment, we can say in general, consumer confidence remains quite low. And, your high and middle income confidence levels remain quite depressed. And of course, these groups do have quite a bit of spending power. And I think some of the positives, and again, this speaks to a point I think that was spoken about quite at length earlier, is that we are seeing appetite for asset-backed credit. I think that still remains intact, and it's supported by, I think, resilient demand in the housing as well as the car market. And recently we have seen that consumption credit, so this is unsecured credit, that uptake has increased. So I think this combined with, the continued recovery in household income and drawdowns on savings has helped to support consumer spending. However, I think the headwinds, have been touched on or spoken about. Those are snowballing. And of course, they're spurred by very high inflation. The point was made that maybe we may be reaching a peak, but I think inflation still remains relatively high. Interest rates have increased, and we expect them to continue to increase. And this will weigh on discretionary incomes, and I think ultimately household spending. And of course, it will have a disproportionate impact on low to middle income segments. Thanks, Helena.
Yes, thank you very much, Ilanya, Lynette, and Mamelo. You have really set the bar high, and it is difficult to follow on this, but let me try. I think the first thing we need to keep in mind if we think about these survey results and the third quarter and what it tells us is three concepts. The one is levels. The next one is quarter-on-quarter growth, and the third one is year-on-year growth. So, our surveys, as Ilanya so nicely pointed out, refers to the year-on-year growth rate. But I will show each time also what has happened to levels. And we, as analysts, often forget that part, whereas I think when you are in the business, you definitely are aware of it. So let me share my slide and take you through it. So here I start off with tourism accommodation. These are numbers generated by Stats South Africa. And the first thing you would notice is the big fall we had, the complete drop to almost very little stay nights sold in hotels. And then since then, it slowly recovered, but there were setbacks. The fourth quarter of last year stands out. But then in the first quarter of this year and the second quarter, levels continue to improve. But to make it more practical, if you have a guest house with, say, 10 rooms, right in the middle of the lockdown, in the second quarter and third quarter of 2020, it was empty, zero. No rooms were rented out. Since then, you have received a few guests, perhaps 2 last year per month, and then it moves up. It's now, say, about 7 out of 10, so 70%. And that is an enormous increase from the 5 a year ago, and the 5 is an enormous year-on-year increase from the 2 previously. But at 7, you barely manage to cover all your costs. You need at least 8, only from 8 you start generating a decent return on your investment. And especially after 2 years where you had to survive on your retained capital, this is still a tough environment. On top of that, you have cost increases. So we are in the midst of 2 weeks of load shedding, so you have to provide for that. But then other costs, in addition to if you have electricity, eventually that increases. I don't show here what's happening. So in our survey, you see this massive increase in the year-on-year growth rate. That seemed to have peaked in the second quarter and slowed a bit, but it is really still exceptional. You know, we haven't had in the survey's history such high growth rates. I don't show here what is happening to restaurants, but the graph would look exactly the same. There again, so the third quarter is doing better than the second quarter, but the tempo of increase is coming down from spectacular rates in the second quarter, now in the third quarter. So like here, it is moving a bit lower, but it is still making up for lost ground over the past 2 years. Within restaurants, there are also different factors at play. I think they, even more so than the hotels, are challenged by cost increases. So you have especially your food, and that forces restaurants to hike menu prices. And consumers face many demands, you know, as presented nicely in the first part of this webinar. So the consumers are sensitive to price increases. They expect a certain price for a main course, and if that is now 10 or 20 rand more per main course, it may put off some people. They may not order the dessert, or instead of going out eating twice a month, they only go out once a month. So these play a role, but restaurants have very little scope not to pass on this price increases. Then, if I think about the current situation, the way forward, it's certainly we are moving into summer season, peak season. Compared to last year, we expect significantly more international visitors. That bodes well for accommodation, but also for restaurants. There has been some scarring, nice word for some businesses that have closed down. So those that have reopened or opened newly, they certainly benefit from that, you know, that they survived and find these customers. And also the start of events and exhibitions, that bodes well. And I would expect this quarter-on-quarter growth to continue into the fourth quarter, the first quarter of next year, and then we get into our low winter season. Then the situation will slow down because we have made up for this period of the lockdown, and our main source markets, the Europe and the US, they struggle with high inflation, erosion of real incomes, and that obviously can have an impact on visitors to South Africa. We also still await for China to open its borders and for Chinese visitors to eventually return. So there's a lot of scope for improvement in the short term, but then from the middle of next year onwards, that upward momentum is likely to slow a bit. Also, a big part of many hotels' business is business travel. That has also recovered, but is still way below pre-COVID levels. Likewise with exhibitions. So there is more structural changes taking place, and it will take a while for things to come back fully. If we then move on to the second set, so hotels and restaurants make up 15% of the total other services, then let's move on to transport. And here I'm showing you the biggest component of transport, that is land freight transport. And that has surpassed pre-COVID levels in the first quarter of last year. Since then it is picking up. But if you look at the year-on-year growth rates, and as reflected by our surveys, you saw this big fall here in the third quarter of last year. That was linked to the unrest in KwaZulu-Natal and Gauteng, and then it bounced back again. And we had a bit of a poorer second quarter as the flooding in KwaZulu-Natal and other disruptions at harbors affected land transport, but there has been an improvement in the third quarter of this year. So it is a bit volatile, but it is at least from the third quarter, transport is picking up. Also important in this sector, which makes up 22% of the total, is what's happening to support services. So you have freight forwarding, you have tourist agencies and travel agencies, you have storage, and that, if tourist travel agencies, they are still under severe pressure, much better than this time a year ago, but it's not fully recovered. And if you look at passenger transport, there we need the return of the big tour groups, specifically from Asia and China, for transport to recover fully. Freight transport, especially land freight, they have gained some market share from Transnet because of disruptions in their operations. But land freight is closely linked to the other sectors in the economy. Mining is one, agriculture, but manufacturing, and they are important vehicles to move stocks, to inventories. If, as we saw in the beginning, the industry is weakening, then certainly the movement of stocks will slow, and so we will see downward pressure on the volumes of land freight transport, just as a delay from what's happening in the other sectors. The sector also seemed to have an oversupply, so there's a lot of competition, and then we had this immense increase in diesel prices. So even though volumes are still picking up, it is profitability of the sector struggle. Then the third sector I'm covering is real estate. Differently to what I, for example, think, it's not only the sale of secondary sales of properties in the secondary market, that makes up about a quarter of the sector. The other 3/4 is made up of property management, so where you rent out and arrange for rentals of industrial and residential properties. So here, real transfers bounced back after the lockdowns. Part of it was because transfers took place during the lockdown, so there was a backlog, and there was also internal movement in the country, so-called semigration. So real estate activity, sales of property did quite well for a couple of quarters, but now our survey show there is some signs of weakening, and that's to be expected given that this backlog is now being run down. But you also have interest rate increases, and you had the flooding in KwaZulu-Natal, which temporarily stopped that transactions in that province. So within the real estate sector, property management becomes even more important. Unfortunately, at this time, right at this time, you see increased demand for rental, especially residential rental, partly compensating for what's happening on the sales side. And then the last sector I'm covering, and this is also the most important one, is business services. So that makes up 45% of the total of other services. And here, this sector typically depends on what is happening in the other sectors. It is for us as analysts not so visible, but it forms a very important part in the economy, also as part of contributing to GDP, and it refers to computer services. You have different lawyers and accounting, and then you also have the consulting, engineering, different professions in linked to the building sector, and then advertising, and at the end you have a group which covers debt collection, interior design, exhibitions, and plant cleaning. But important here is the link to the building sector. So specifically consulting engineering, we haven't talked much about the building sector, but there is long delays in buildings. The plans are improved, but the buildings are not started yet, or a postponement of projects, and that obviously affects consulting engineering, and that has kept confidence low, but now fortunately this has started improving. You have accounting activities, computer services, and other support services to the business sector picking up, but like the others, you had this very high year-on-year growth that has now slowed down. So to end up, what does this all tell us for GDP? I think there are two ways of looking at it. If we take consumer spending, you had Ilanya covering the retail side, so that is consumer spending on goods. You have your non-durables, your food, which is not very volatile. That's a basic necessity, so everybody's spending on that. And but that is, you have two different forces. You have, on the one hand, you have the high inflation that erodes spending, but then you have the SRD grants, where those people, most of them, use that funds to spend on food. Then you had the recovery in semi-durables, the clothing, as people go out again, and you have durable goods, which initially performed well, but now slowing down. But in total, if you look at the different income groups, the middle and then especially the higher income group, and higher income group is people above 20,000 Rand per month, they spend more on services. So it is going out to restaurants, perhaps a weekend away, and then also events and other entertainment. So there is definitely that shift towards services, which is good for providers of that. And the providers we refer to is the restaurants and the hotels. On top of that, we have the summer season coming up and hopefully the return of international visitors. If you are from Europe, you can escape the cold and perhaps also blackouts there. And then you can come to South Africa and at least you have some sun and good weather here. That sector. And then the other point I'd like to make in conclusion about services. So this is definitely countering some of the downward pressure we see on GDP. So if you look at what's happening in manufacturing, to some extent the building, the recovery has hit a bit of a flat spot. You have this international uncertainty and the impact on South Africa. So a bright spark is definitely what's happening in services, but that will support GDP growth in the second half of this year and even into the first quarter of next year, making up for the slowdown in the other sectors. I haven't showed you anything about price increases and employment, but the two slides that Ilanya showed on these topics are exactly the same for other services. So we also saw there a peak in price increases in the second quarter. The year-on-year growth rate is still high in the third quarter, but definitely it came off from the second quarter. Likewise, employment is still picking up year on year, and we would expect that to continue, even accelerate in the fourth quarter compared to the third quarter, because we have restaurants and hotels filling up, and they will then take on more workers, not all permanent, but then at least for temporary work. Yeah, that covers my overview. So there are opportunities for questions or comments. I'll leave that to Lisetta to moderate. Thank you very much.
Thanks, George, and Mamelu, Lynette, and obviously Ilanya as well. I don't see any comments on the chat box yet, but we did have one very shy participant who said he preferred to use email as he wasn't sure. We'll get to it. And the question is actually about the retail trade. So you spoke quite a bit, Ilanya, about higher input costs and so forth. But what does this all mean for profitability within the retail sector? Is there anything that the survey can tell us about that?
Yes, thanks, Lisetta. I think that's an interesting question, and it's coincidentally also a nice check, or let me put it this way, the question around profitability is a nice check for some of the other responses that we get. So we ask retailers whether they expect profitability this quarter to be up, down, or the same relative to last year. And I actually just pulled the numbers here now. On aggregate, the profitability index is down in this quarter. It was at -14 in the second quarter, and currently it's sitting at -22. So retailers are certainly under pressure also from a profit perspective. -22 is still above the neutral level or the long-term level of -41. So it's not that retailers are completely missing the mark, but the point is that profitability is trending down. This is especially the case for non-durables. I think that also tracks what we saw with the confidence results, but not so much the case for semi-durables. In fact, for semi-durable goods, profitability seems to be up a little bit. I think it speaks to the rate of price increases, purchase price increases and selling price increases specifically. So if you remember back to the graph that I showed of purchase and selling price increases for non-durable goods, both of those indices were sitting at 77, which means if retailers are pushing through all of the price pressure that they see on the purchase side, there's but onto consumers, there's not much scope for profit to be made. Yeah.
Thanks. I see a question also here, how volatile are the expectations results? Typically, can they be used as a leading indicator? So I assume that would be the expectations regarding the next quarter. So I'm going to direct that towards George as the survey guru in South Africa. I think he would be the best to answer that one.
Yes, in principle, the expectations of the respondents gives us some idea what the industry expect. But in my own experience is that over years, it is often what has happened in the current quarter, people expect that to continue. We cannot expect from business people to know more about things than we do. Sometimes they are pleasantly surprised. Things turn out better than they previously expected. Then we often see confidence increasing. We also see what if we look at business cycles at the peaks or the troughs, where they're often, business people are surprised. So at the peak, they would expect things to continue improving, but all of a sudden things start deteriorating, and it only has their assessment have to be disappointed only 1 or 2 quarters, then they start changing their view. That often happens much quicker at the top as in the bottom. It is as though this pessimistic feeling of the future continues, and then you see this outperformance, you think this can't be, this is too good to be true, and then another quarter, and then only in the 3rd quarter you realize, no, but things are really improving here. So we do take account of the expectations, but I wouldn't use that at the moment as a nowcast or, absolutely, it is additional source of information. But perhaps some of the respondents would also like to comment or give us feedback. We always wonder how you think about this situation. And yes, people on the ground level obviously know, they have a unique situation. Say you are in KwaZulu-Natal, what is after the flooding, what's happening there, or in Gauteng, whatever.
Thanks, George. There was one question about whether there will be a replay link made available. We do hope to make this available on our YouTube channel, so please keep an eye on that. We'll advertise that on our website as well. There's a question about the impact of imports coming into South Africa. That is not a question we necessarily track per se, but I can add from the comments and so forth that we do sometimes see insights in that regard. I think there is another question which might be interesting, so I'm not sure if you want to, who of you would like to jump on that, regarding the costs, anticipating another unrest, road freight being one of the highest. I think this is a broader economy issue and not necessarily a trade issue in that regard, a concern about further unrest and protest. I'm not sure if there's anything specific from the retail or other services side you would like to add.
Yeah, perhaps Lisette is to mention, and that doesn't only apply to the 2 sectors we've covered today, but in all the comments we get from the building contractors, also manufacturers, it stands out how many businesses complain about regulations and administrative burdens and getting things sorted out. So red tape, that, if I think we do a word count of that, it will come out very high. So businesses are frustrated. They can't get their jobs done, and that frustrates them. And that is already on top of having a tough time. While Ilanya talked a bit about profitability in the retail, Certainly, sales are very important, and Lynette continuously remind us, businesses in South Africa think about turnover. So we as analysts think about the units sold, whereas businesses have a budget. And if that budget is also achieved with higher price increases, confidence are doing well, as we see in the retail. But the other side of the coin is what's happening to costs. And there is definitely, if you have, I've seen on a Facebook comment from a restaurant, it starts with explicitive Eskom, and then it says, okay, if I do have the generator, who is paying for the diesel? And now this morning in a discussion I heard that is also now becoming a problem. So retailers, businesses face these daily challenges and frustrations, and that certainly weigh down on confidence.
And I also think that ties in nicely with that last question about load shedding. I think if you would do a word count of a word cloud of the commentary, it would be red tape and load shedding. It would feature, especially also from my side, I look at the manufacturing angle, and that's definitely the word that pops up the most. And again, that also flows into the cost picture. I think we have to close. There's building work happening next to our building, so something's keeping the economy going. We will most certainly make a link available to the presentation on our YouTube channel. The presentations will also be uploaded on our website. If you can't wait, you can also check out the retail survey and the other survey results that are already on the website. The website is ber.az.za. I would like to once again thank you, George, Elania, Lynette, and Marmelo. It was great to hear your views on the services sector. I would also again like to highlight our survey respondents. Thanks so much for your continued participation. Without you, there would be no survey nor anything interesting to discuss. If you have anything you would like to, afterwards, if you have any questions for us, please use the berconference@sun.az.za email address, and we'll get back to you on that. Thanks again, and I hope you have a wonderful Tuesday.